If you think the next great AI fortune will be made by staring only at chips, you are already looking one layer too high. That is the first mistake. The crowd always falls in love with the most visible part of a boom. In railroads, it was the locomotives. In the internet era, it was the websites. In the first wave of artificial intelligence, it was the chip names. Fine, that is normal. The public likes the obvious hero because the obvious hero photographs well. But the longer I do this, the more I learn the same lesson again and again. The headline is almost never the full story. The real money often lives one layer deeper, where the bottleneck becomes unavoidable, and the system can no longer function without fixing it. That is the mother line. AI is no longer just a software story, or even just a semiconductor story. It has become a power story. And once you understand that, a huge amount of what looks random in the market starts looking like a very orderly transfer of capital toward one problem. America can no longer postpone electricity. Reliable electricity, dispatchable electricity, transmission capacity, substation, switchgear, cooling, power conversion, grid modernization, and the boring companies that make all of that possible. That is where the focus shifts once a technology wave stops being a fantasy and starts behaving like an industrial system. The uploaded reference makes the point through politics and policy. It opens with a dramatic claim about Donald Trump signing an executive order and $1 trillion redirection into America as failing grid. But underneath the political wrapper, the more durable story is even more important. A policy headline can accelerate a move. It can validate a move. It can put a stamp on a move, but it cannot create the entire move by itself. The deeper move was already happening because the physical world has started saying, no, that matters. Computing does not care about narratives, it cares about energy. A data center can have the best chips in the world, the best engineers in the world, the best software stack in the world, and the best capital backing in the world. If it does not have enough electricity, it is still just an expensive idea waiting for a plug. That is the first mechanism I want you to understand. I call it the invisible bottleneck. Most investors still think AI scales like software in the imagination. It looks almost weightless. Code goes in, output comes out, margins rise, and the future arrives. But AI at industrial scale is not weightless at all. It is profoundly physical. It needs land, it needs concrete, it needs cooling, it needs chips, it needs water. In some cases, it needs transmission. Above all, it needs enormous continuous power. The reference document points out something most people still do not really feel in their bones. These data centers are not consuming a little more electricity. They are pulling at the grid like a new industrial civilization got plugged in overnight. The old grid was not built for this. It was built for a very different America, a world of refrigerators, lighting loads, industrial baselines, suburban growth. Yes, but not an endless fleet of energy-hungry AI campuses trying to operate every hour of every day. That difference is so important because it changes what AI investing even means. If the first phase was about who could supply the brains, the next phase becomes about who can keep the brains powered without the entire system choking on its own demand. That is not a minor shift. That is a mother shift. And when mother shifts happen, the market almost always behaves in the same sequence. First, the crowd owns the symbol. Then the institutions own the system. That is why I find the follow the money instinct in the reference document useful, even though I would explain it in a calmer way. Institutions do not always have a better IQ than the public, but they often do have a better habit. They study where actual dollars, contracts, and backlogs are already forming rather than living entirely inside story. First investing, the public hears the story and then looks for a stock. The professional sees the backlog and realizes the story is already becoming revenue. That is a huge difference. The second mechanism is what I call contract gravity in speculative markets. Forecasts attract attention. In real industrial cycles, backlogs attract capital. That distinction can save you a lot of pain. A backlog is not a promise from a charismatic executive. It is not an inspirational thread on social media. It is not a grand future presentation. It is work that has been sold, contracts signed, revenue, largely waiting to be recognized. That does not mean risk disappears. It means the story has moved from wish to schedule. That is a much better place to invest from. This is why the companies sitting inside the grid buildout are so interesting. The glamorous investor wants the name everyone already knows. The more patient investor starts asking, who is actually touching the physical work? Who is building the high voltage lines? Who is redesigning the substations? Who is supplying the switchgear? Who is handling the thermal systems? Who benefits if the government, utilities, data center operators, and military facilities all end up spending years throwing capital at one structural bottleneck? Those are the questions that produce better portfolios. And the answer, at least in the logic of this reference text, is that there are 5 broad layers getting paid: off-grid power generation, grid construction and transmission, electrical components and power management, cooling and thermal control, and the raw material and fuel inputs beneath the whole chain. That structure matters because it stops you from treating this as a one-stock lottery ticket. It turns the opportunity into an ecosystem. The third mechanism is what I call off-grid rebellion. This may be the most important behavior change hidden in the whole source document. The market is so used to thinking of the grid as a public utility problem that it has not fully absorbed what happens when private companies stop waiting. If a hyperscaler cannot get the electricity it needs on a timeline the business can tolerate, then the hyperscaler stops behaving like a customer of the grid and starts behaving like its own utility. That is a radical change in posture. And once that starts happening at scale, entirely new spending channels open. Fuel cells on site gas generation, small modular nuclear dreams, dedicated energy campuses, private power purchase agreements. All of it begins making sense in a world where waiting 5 to 10 years for a grid interconnection is not a realistic business strategy. This is why I think many investors misunderstand the Bloom-type story. They see a stock move and think excitement. I see a company sitting in the right place when urgency turns from conversational to operational. A data center that cannot wait for the grid does not need a beautiful story. It needs power. Now that is the sort of demand that changes pricing power, backlog visibility, and market perception all at once. The same logic explains why nuclear, even in miniature or modular form, keeps returning to the conversation. It is not because the public suddenly became patient. It is because reliable 24/7 power, with a cleaner political label than coal or gas, begins to look strategically valuable when the demand curve has no intention of slowing down. And once nuclear re-enters the conversation, uranium re-enters the conversation. And once uranium re-enters the conversation, the input chain starts re-rating too. That is how second-order investment waves form. They do not need the public to understand every engineering detail. They only need the public to arrive late enough to notice that the money has already been moving for a while. The fourth mechanism is what I call the picks and shovels reversal. The public likes to imagine that the best return in a technological revolution belongs to the most futuristic object. Sometimes that is true. Often it is not. Very often the superior risk-adjusted position belongs to the companies supplying the necessary but less glamorous infrastructure. That is why I have always admired toll roads more than carnivals. A toll road does not need to guess which car wins the race. It gets paid because the road is necessary. The grid build-out has that quality: transmission contractors, switchgear manufacturers, thermal systems providers, power conversion specialists, raw material suppliers. All of these names live closer to the toll road than the carnival. They do not need every AI business model to work perfectly. They need the demand for electricity and infrastructure upgrades to remain real. And on that point, the evidence is much firmer. This is why the reference file's emphasis on names like Quanta, Powell, Vertiv, Viker, and similar component and infrastructure businesses is logically stronger than a simple headline chase into whatever AI stock happens to be trending. These are not vague moonshots. These are businesses attached to physical necessity. Physical necessity is an underrated investment characteristic. It is harder to fake. Now, that does not mean you buy them thoughtlessly. A stock can sit inside a wonderful secular trend and still be a poor buy if the valuation got far enough ahead of the operating reality. That is where a lot of retail investors lose discipline. They confuse being directionally right with being automatically protected. They think a strong theme removes the need for price sensitivity. It does not. But neither does a big move prove the opportunity is over. That is where I think many people get trapped emotionally. They see that a stock already doubled and conclude they missed it. Sometimes they did. Sometimes they are just early in a multi-year re-rating of an entire industrial system. The difference is not visible from the chart alone. It has to be judged by the business, the backlog, the capital cycle, and how much of the thesis still sits in front of the company rather than behind it. That is adult work. The fifth mechanism is what I call the late but right principle. Wall Street does not always get paid for being first. Very often it gets paid for being right after enough evidence exists to reduce the odds of self-destruction. This is one reason I do not romanticize buying at the absolute bottom of a theme. The public has been taught that greatness means being earliest. In reality, being slightly later with better evidence, better trend confirmation, better capital flow awareness, and better contract visibility can be a much more intelligent way to make money. This matters a lot here, because this grid and power theme is not built on one executive order. It is built on an industrial mismatch. Demand is rising faster than the legacy system can accommodate. Public policy is becoming more supportive, not less. Utilities, tech giants, contractors, and government entities are all being pushed toward action by the same constraint. That is the kind of alignment that can carry a trade further than people expect. Now let me address the political wrapper more directly. The reference piece frames the move through Trump's energy law and executive order language. Fine politics matters. Policy accelerates money. Contracts get signed faster when Washington decides something has strategic urgency. But as an investor, I never want to build my entire thesis on the personality of one politician or one press release. Politicians come and go. What I care about is whether the policy is leaning into a existing industrial necessity or trying to fight one. This policy, as described in the source, appears to be leaning into necessity. Keep dispatchable power alive. Accelerate procurement. Use emergency authority. Support long-duration power purchase agreements. Spend on grid reinforcement. Those are not random gestures, those are admissions. And admissions by the government are usually worth watching because they tell you the state has finally recognized a bottleneck the private sector was already running into. That is useful information. The sixth mechanism is what I call state validation of private pain. The market usually moves before the state can explain it neatly. By the time Washington says a problem is urgent, the private economy has often been suffering from that problem for a while. That is why policy headlines can become investable. Not because they create the trend from nothing, but because they validate that the pain is large enough to justify money, contracts, and political cover. So when the state says the grid needs help, I do not hear merely policy. I hear proof of stress, and stress is where real spending comes from. That brings us to the question that matters most. How should an ordinary investor think about this without turning it into a reckless thematic binge? My answer is simple. Think in buckets. A core bucket of established infrastructure names attached to the buildout. A second bucket of off-grid and distributed power names for the data center rebellion. A third bucket of component and power management suppliers that act as picks and shovels for the picks and shovels. A fourth bucket of raw material and fuel exposure. If the nuclear and conductor story continues to deepen, and above all, use backlogs and real contract evidence as the gravity field, not just narrative excitement. This keeps you grounded. It lets you participate in the theme without reducing yourself to a tourist in a hot trade. And it reminds you that the point is not to buy Trump's law or AI as labels. The point is to buy the scarce functions the system now has to fund, because demand already broke the old configuration. That is the adult version of the trade. The seventh mechanism is what I call the invisible utility thesis. Private companies becoming their own utilities is one of the most profound shifts hiding in the reference document. It tells you that energy is no longer merely an input bought from someone else. For the biggest winners in AI, energy is becoming part of strategy. Once that happens, the businesses serving that transition stop being side characters. They become strategic infrastructure. And strategic infrastructure usually commands a better multiple than forgotten cyclical suppliers, at least once the market fully sees the transition. This is why I think the long-term winner here is not the person who memorizes a dozen ticker symbols and feels clever for a week. It is the person who understands the architecture. AI creates power demand. Power demand breaks the old grid timetable. Broken grid timetables force private workarounds. Private workarounds plus public spending re-rate off. Grid power, grid builders, component suppliers, and key materials. That is the chain. Once you see the chain, the trade stops feeling random. It starts feeling structural. And structural trades are the ones I like most because they can survive more headlines, more noise, and more skepticism than the average speculative story. So here is where I come down. The biggest mistake investors are making is assuming the AI boom is still mainly about the computing layer. The computing layer is still important, but the power layer is becoming decisive. And because the power layer is more boring, more industrial, more contractual, and less glamorous, it is exactly the kind of place where serious money often arrives first while the public is still staring at a shinier screen. That is the opportunity. Not because the trend is invisible, because most people still refuse to look low enough in the stack to see where the next scarcity is tightening. And in markets, scarcity is where the real money begins.